Okay, well, good afternoon, everybody, and welcome to the Market Matters Outlook on today, April 7th, 2020. And I want to thank you for joining us today. Just a few housekeeping items that I wanted to touch on before we get started. We have received a few questions about the security features of Zoom. I know there's been a few articles been written about security features and vulnerabilities with Zoom. We want to let you know that we are aware of the issues, and our registration process actually negates most all of these security loopholes that hackers have been trying to exploit. Generally, however, I would note that I will never send links through the chat box, so please don't click on any during our time today. For future Market Matters episodes, we'll likely have additional security enhancements, but more to follow. I think we'll update you in the email we send on the next invite. And along those lines, I would encourage you to send questions via the chat feature so that I can try and layer in answers along the way. And if I don't do it along the way, then we'll try to get to them at the end. Everyone in the webcast will be placed on mute, and you should only be able to see me in the webcam and no other participants. So let's get started here. Turning to the agenda, we'll follow a similar pattern or format for prior Market Matters episodes. I'll review the current COVID-19 fact pattern, then move to some economic and market implications. We've kind of condensed those into one topic area, not two separate like we used to have. And then finally, once I get through the market and economic implications, we'll touch on the special topic that a lot of you have wanted to know more about. And I would also say that this is a great opportunity, even through the chat feature, if there are other topics that you wanted to learn more about, so please let me know, and either through email using the questions@gratuscapital.com, or through this chat feature, we'll be able to pick back through. So with that, let's get started. So, still believe that what's going on with the COVID virus will be driving a lot of what's happening from a perception standpoint or even market standpoint. I think that can clearly be seen in some of the moves we're seeing in equity markets these days. But, this is a great chart that JP Morgan put out a few days ago, basically just showing where most developed and some developing countries are in their infection rate progression. And you can see, on the recovery phase, we've got China, now Korea, Singapore and Italy are actually really close to the peaking of the death toll rate. Actually, in Italy, the last couple of days have seen declining rates of deaths, which is actually very good. But you can still see, the heart of Europe has yet to go through this late accumulation phase. So, the US, UK, France, Germany, still continue to work our way through the parabolic stage and infection growth rates and fatality rates. I mean, perfect example, New York reported the highest number of deaths on any given day yet yesterday. So I would definitely anticipate that is likely to speed up, which is also in his press conference over the weekend, President Trump mentioned this week will be probably one of the more brutal weeks to go through from a death toll standpoint. So the news is going to get a little worse before it gets better, but I guess the good news is that we are approaching, at least in the US trajectory, the peaking of new infection rates potentially, as well as death rates, and then that would also put us on the recovery phase. So there is light at the end of the tunnel, I guess, and that's also what the markets are sniffing out as well too. This is a chart I think is really interesting. So some of the investment banks are now starting to put together some of their estimates on when the lockdowns could be ending potentially, and they're using three different scenarios. The first column here, and this is just a cross section of Europe. First section here just says, based on what public officials are saying, when would restrictions be lifted around travel and movement? For the U.S., we're the latest in this, the latest adopter for the virus. April 30th is what people are indicating. It's also what the president would like to say is possible. I don't necessarily think that is possible, given that we still have, as you'll see in the next slide, a number of states not in full lockdown mode yet. This is the estimated date based on restrictions that were placed using the Wuhan or Hubei experience in China. So late May is based on the Chinese experience. What this is in the case of Deutsche Bank is estimating restrictions could be lifted. But I think more likely is this third scenario here using the SARS containment. Public health officials are now going to be much more conservative, I think, in relieving travel restrictions, because travel restrictions are one of the primary ways to get virus containment in addition to testing. And I think in an abundance of caution, I think, and using kind of the SARS episode from 2003, this is what most estimate restrictions being lifted. So that would bring it to June 19th, 20th in the US. Most schools are now closing down, so that takes us through the end of the school year. But late June appears to be the best estimate that we've got for when restrictions are going to be lifted. And this is what I was talking about, the shelter in place. This is why we could end up going longer than that SARS estimate of June 19th. It's because you still have, this is a nationwide shelter in place orders by state. And you can still see that there is a number of states that have not gone on full lockdown. So finally, Florida and Texas have, but you still have a number like South Carolina, Arkansas, Oklahoma, big parts of the Midwest that have not yet gone on full lockdown. And that's all that's going to do is just prolong the travel restrictions or the lockdown bans, because it's going to lead to, a higher rate of infection than would be if we were all on lockdown. And that's not really good for anybody. But that's why maybe this June 19 date could be a little bit longer. It's because of this dynamic we have right here. Moving to the testing phase, this, as you may recall, has always been my base case. That is, testing has to ramp up in a major way for us to get some idea of not only who's infected, that is showing asymptomatic symptoms, but also containment in order. And you can see that we've kind of ramped up here. This day, April 4th, I think, was when a lot of counties and municipalities got shipments that were in stock and storage from a provider. But it really has this more linear trajectory if you use information from the 5th, 6th, and 7th. It's really more of a linear fashion, but that's still good. I mean, that's, we're getting a lot more by way of testing done in the US, and that does give me hope that we're going to get to a system of nationwide testing. Actually, this morning, Walgreens indicated that they're going to have their first drive-through testing sites up and running by the end of, I think it's this month, by the end of this week. So that's certainly a step in the right direction. So testing is one of the keys to solving this. And then, one way that I think, so there's been a lot of people worried about reinfection rates, like there were in the Spanish flu episode in 1918, where there was a big wave of infections in the summertime and then kind of tapered off toward late summer, and then another wave of infections in the fall. But one thing to note is that, back then we didn't have, as I mentioned last time, antivirals of any sort, or other medications that might help with infection. But this story I read over the weekend, I think should give everybody hope, and that is Bill Gates and his foundation has agreed to funding the top 7 candidates for a vaccine, and he's doing this fully well knowing that only 2 of them are likely to stand up to the medical scrutiny. So he's throwing billions of dollars at 7 factories that he is personally going to fund with his foundation. Only 2 will likely survive through the medical trials, but he knows that this is going to happen, and he's doing it anyway. And this is all to get this vaccine up and running so that, when we approach reinfection time towards the fall and winter, that we hopefully have something on the books, at least in some advanced stage of testing. So this is, I think, maybe some upside to the time frame around getting this thing solved in a more permanent way. So moving to the economic and investment implications, as I mentioned in previous episodes, these are just some items that we still are talking about with clients and all of you. We did rebalance, for those that didn't know, on March 13th, holding short-term cash, which is the same as last week. But I think the more I read about some of the packages coming through from a stimulus standpoint or monetary support standpoint with the Federal Reserve, inflation hedging is becoming more of a priority for our investment team. So we're looking at ways that we can access that in a way that makes sense from a portfolio standpoint. Still have a large cap US overweight. We did end up last week adding to some international mutual fund exposure by selling down some of our international index exposure. And the primary reason you would do that is if you thought that stock selection had a good opportunity set in the current environment. I think if you look at the difference between what emerging markets, let's just say Brazil, has returned this year, which is around -40, versus what developed markets internationally have performed. And actually, in the best case, Switzerland, believe it or not, year to date has a positive return. And that's probably because they have a lot of food companies like Nestle or drug companies like Roche based out of Switzerland. But when you have that kind of dispersion and return, that means that the opportunity set is really high, good for active management. And that's one way that we think we're adding quite a bit of value on that front. And that's certainly coming through, I would say, on the international sleeve. Fixed income markets, it's a little hard to read on the slide, but there are some really good opportunities right now, not only in short-term corporate bonds or things like leveraged loans, but also on the muni bond side. We've been pretty aggressive in adding to some of those exposures, either in mutual funds or individual bonds. And I'll show you why we're doing that in just a minute. And then finally, REITs have moved up our research agenda because despite some of the healing that's gone on over the last few weeks, there's still a lot of ambiguity around the real estate sector, around how forbearance is going to flow through from a cash flow standpoint or evaluation standpoint. So, there's a lot, and furthermore, there's a lot of disparity between the best performing REIT sector, infrastructure like towers, and the worst performing like retail, think Tanger outlets and things of that nature. So we think there's some really good opportunities for those that are active in the space, and we're looking at ways in which we can access that return stream potentially. I would point out that through all of this and just taking a little bit longer approach to portfolio management, again, going back to the old adage of why we just don't invest 100% in equities and call it a day for longer term portfolios. In some cases, for younger clients, we do that. But for most of you that are taking, cash flow out of your portfolio or, to support lifestyle, diversified portfolio makes a lot of sense. And I think this is also a slide that should tell you that that's actually a really good idea from a return standpoint as well too. Because as this would suggest, now this data is through, I believe it's through March 24th or 25th. So it's a few days old, but I think the context or the returns wouldn't change that much. And if you look at it starting in 2002, you can see the return by period where the equity market did, a lot better than a diversified portfolio. And just for this example, we're considering a diversified portfolio, something to be similar like a 60-40 portfolio or 65-35. And you can see what the result is through March 23rd, or I'm sorry, through March 27th. And that is, over time, your return is actually better in a diversified portfolio than just sticking with the S&P and calling it a day. And the primary reason is because you'll notice that the drawdowns are a lot less than the S&P is. So you have half the drawdown here in the 2000-2002 period, about 13 percentage points better in 2008, and about 9 percentage points here in this example. And I think just as a reminder, the math of a drawdown is not that a 30% down move does not mean you need 30% on the upside to get back to break even. It's actually much more nefarious. It's something in the neighborhood of 65% up move to get back to break even on a 30% drawdown. So it's a lot harder to recover from a drawdown than it is to not lose as much. And I think that's the reason why, even at when you're in your 40s potentially, you've got some diversification in other sectors outside of just the S&P. So this is just a refresh of the slide through last Friday on 4 different equity markets. And I've noted when we did our Market Matters webcast, just for reference, just to give you an idea of when we were talking about things. S&P is in the red line, the Russell 2000 small cap index is in the blue line, the developed international market is the green line, and emerging markets are in the pink line. And same performance trends showing as they did last week, where you've got S&P starting to create a bigger gap in performance to both developed markets internationally as well as emerging markets, and then a pretty wide gap between the S&P large cap and small cap. And as you know, my whole contention, for those of you that have been in our webcasts or market update outlook over the last couple of years, has been small cap has been pretty vulnerable to funding issues, and I think that's really coming through right now. And just wanted to revisit this slide from last week because I still think everything that I'm seeing would indicate that we are in a event-driven bear market, not necessarily a structural or a cyclical. And that's key. Now, this idea is starting to get a lot more play since I mentioned it last week. I saw the Wall Street Journal mentioned it, KKR, BlackRock, all have mentioned it later in the week. And I think it does make sense because this was an unpredictable event that was kind of a shock to the market, and it was a health crisis. It wasn't a structural bear market, which is, things like over-leveraged banks or an over-leveraged consumer just not being able to buy anything anymore. And it certainly potentially had the potential to be a cyclical bear market where, the economy starts petering out. But, data points actually that we received in right after January and February this year would indicate that we were reaccelerating as an economy coming out of 2019. So that I think might help put to bed that cyclical argument. But the reason that I'm focusing on this event-driven is because the time to recovery from the start to finish is much shorter than it would be for structural or cyclical in months. So that would be a good thing if this played out the way we think. Looking at the fixed income market, as you all know, I have a keen focus on fixed income, and I think it's well placed because that does tend to drive a lot of what not only the central banks are doing, but also how other things should be valued. So just by reference, the red line is the aggregate bond index, which is primarily comprised of government bonds. The blue line is the corporate bond index. The green line is the high yield index, and then the pink line is the emerging market bond index. And there's a couple of interesting things to note here. I've pointed out when the Fed announced their credit support vehicle. So, and that was actually right around this time. So it was right around the same time we had our Market Matters webcast. But, a few things, corporate bonds have rebounded far greater than both emerging market and high yield. And I think that just makes sense because we've still have yet to see how the coming, depression type contraction in the economy is going to impact the high yield bond market to any great degree. And so we just need to see a little bit more evidence of how that's going to come through. But by all accounts, the investment grade indexes or the investment grade companies are actually doing just fine. Matter of fact, last week, I believe there was over $280 billion of new bonds that were brought to market. And that's the biggest 1 week issuance ever, number one, but also is more bonds issued in that 1 week than in all of last year. So I think that just tells you there is a demand for higher grade corporate bonds, not necessarily so for the high yield index. So we're keeping a little bit of a distance between these two categories right now, but we still think there's quite a bit of opportunity in the corporate market right now. Although, and this is what I was talking about, questionable business models, if they were questionable to begin the crisis with, they're likely not going to become unquestionable now. As a matter of fact, companies like WeWork, as you all know, I've been a big Pollyanna on WeWork, and their questionable business model, meaning that they have short-term leases and long-term obligations. And now it's finally starting to be priced into their bonds. So WeWork does have one public security out there. It's a convertible bond due in May of 2025. You can see what's happened to the price here recently. They were supposed to go public middle of last year, which is why the bonds rallied. That didn't happen. And you can see there was a big hit there, kind of climbed back up as the economy was getting a little better. And now it's really fallen off the earth with co-working space is obviously not a good place to go when we're trying to all exhibit social distance. But, this is one reason why I think high yield bond market is still a bit dicey, because questionable business models won't survive one way or the other despite government stimulus, nor should they. So I think this is just a case study of things that we should be avoiding right now. I do want to point out one change that happened over the week was that the yield curve on the very short end, as we were moving through some of the new programs that were getting spun up from the Fed, is that the yield curve did go negative in the U.S. bond market. This is the yield curve, and what this shows you is that for every U.S. Treasury security from 1 month in maturity, 3 month, all the way out to 30, this is their yield today, or call it a couple of days ago, and then this was their yield a year ago. So you can see how much compression has occurred in the yield curve. But what I also wanted to point out here was that in the 1 month and 3 month, we actually went a bit negative. We're positive again, which is good, but we did go negative. So looking at very short-term government bonds is not something we're excited about right now, primarily because of the yield level, but also it does suggest that over time we would need to see this go higher to get to feel a little bit better about where the economy is headed, because that would indicate inflation might be on the horizon, which would mean economic activity would be occurring, and we haven't seen that quite yet, but this will be something we'll be watching closely. And then, I didn't want to use the same indicators that I've been using, like the VIX index or the CNN Fear Greed Index. And there's a few others that are out there that I do like to pay attention to, because each one's constructed a little bit differently. And this is one from Bank of America, Merrill Lynch. It's just their bull bear indicator. And I think this is really useful to see, because they use a composite of different, market and technical indicators and sentiment. They also use client sentiment from their client base, which is the Merrill Lynch client base, to help create this index. And I think what this tells you is that there's almost no one in their client base that's very bullish right now, which is in their metrics, if there's 0% reading on this indicator, that just means that it's a pretty decent time to start accumulating, which, as you know, we started to do in our equity sleeve on March 13th, and we've March 13th, and we've continued to add selectively here and there. You can juxtapose that to maybe June of 2018, when we were coming in with some really bullish readings. That was not a good time to be buying, and which actually ended up with a 20% drawdown in Q4 of 18. So sentiment is good. And then I just wanted to point this out, about where we're finding value in the fixed income markets. So I just wanted to show you, by way of comparison, where things traded. So this is the bond market. It shows you a number of different bond categories. So leveraged loans, high yield bonds, investment grade bonds, and then a few other types. You can also see what they call the credit spreads. So every bond is priced, or yield is showed as a percentage of, in relationship to the Treasury. So if the 10-year Treasury was 80 basis points and a investment grade bond was yielding 3.8, there was said to be a spread of 300 basis points. And that's just basically what we're seeing here is what's the spread, at the end of last year in the light blue lines or dots, and the spread basically today or last Thursday, Friday. And this is one reason why we think investment grade bonds are attractive, is because they're they're in the 99th percentile for cheapness, meaning that their spreads have not been this high, 90, in 99 observations out of 100. And currently you're looking at a spread over treasury about 1.86%. So now, is a good time to be considering things like corporate bonds. High yield and leveraged loans, those are a bit more risky, I think, and something that we're watching, obviously. But the crisis levels for high yield bond spreads and leveraged loans was in the double digits. So I think we're not going to get too interested, generally speaking, until we get into the double digits in this spread relationship here. So anyway, I just wanted to show you pictorially where we're finding some opportunities there. And then I have seen some questions come in about, is this similar to the Great Depression? And it's fascinating because in a lot of ways the current price performance of the S&P does match fairly closely in percentage terms to what happened in not only 1987 but also in 1929. But I think there are some really key differences this time around, particularly to the Depression corollary, that make things a bit more different. And that is a few things, the key items. And one is that back then there was no Federal Reserve during the Great Depression, which, because there was no backstop to liquidity in the financial markets or in the banking system, the credit crisis was created around in the 1930s that basically prevented banks from lending because no one wanted to take any risk. Today, the Federal Reserve's aggressive support for the credit markets appears to have effectively short-circuited a credit event, which was the lesson they learned in 2008. And that is, if you let banks fail without providing the market some insight as to how this is all going to resolve itself, then you set up for a pretty bad moment for the credit markets. The banking system also was on a gold standard back in from the early 1800s to the 1933. Today, there is no gold standard, it's the fractional banking system. The gold standard is important because it basically enforced budgetary discipline based on price of gold and metrics associated with that. Today, that's not the case, obviously, and there are some risks with the fractional banking reserve system, but it appears to be that they're being managed appropriately for the time being. And then, of course, during the financial depression, the Great Depression, there were many banks failed and a ton of depositors lost significant life savings. And as a result of this, the Great Depression, the Federal Reserve Act was creating the Federal Reserve, but also the Federal Deposit Insurance Corp was stood up during that time, which basically guaranteed deposits up to a certain amount as it exists today. But also, and I think not more importantly, but just as important, the FDIC is now in charge of managing bank failures or wind downs. And evidence of that Sheila Bair during her time at FDIC in the 2008-9 time period basically shepherded the following transactions. Wachovia was bought by Wells, Bear Stearns was bought by JP Morgan, and that I think went a long way to giving customers confidence that their deposits weren't going to be going anywhere. And then, not drawing any implications to this. This is just the more real-time, up-to-date look at where the betting markets say who's going to win the presidential election. And I do think it's fascinating. Every week something interesting pops up. Now Andrew Cuomo has popped up onto the betting line, which is it's probably a flyer for most people, but I guess a lot of folks approve of his handling of the situation in New York, and he's exhibiting some leadership there, so maybe that's why he popped on. But nothing really to write home about, other than I know that the election is on a lot of people's minds, and it's something we should touch on. So finally, I did want to touch on the special topic, pros and cons of gold in a portfolio, and we're not going to spend a lot of time here. This is just for informational purposes. We do, as an investment team, look at all asset classes and categories. So a gold position would fall into the category that we would research more thoroughly. But let me just run through some of the pros and cons. This is just for informational purposes only. So the pro argument, and maybe some of you appreciate the Austin Powers movie Goldmember. This is the guy Goldmember. But the pro argument is that, you've got a hedge against currency debasement by money printing, which, if you look at a lot of the historical examples of what happened to currencies when central banks or governments spent money that they didn't have, that led to hyperinflation. So, the primary examples gold bugs, like Goldmember would point to, would be Weimar Germany or Zimbabwe or Venezuela. We're certainly a long way from that eventuality, but that's just one of the arguments that they would like to throw out there. And it's all by virtue of that, perceived store value. It's also a inflation hedge, a lot of people would claim, because if your currency goes down, it gives you less purchasing power. Therefore, your currency becomes less valuable. That's why some people think it's a good inflation hedge. It's a flight to safety asset during stress periods. So that has been the case in the 2008 recession. And actually more recently, it's resumed that. There are other examples, however, over history where that's not been the case during stress periods. So I think it's kind of a mixed bag relating to the flight to safety asset during stressful periods. But certainly the last two have shown, positive correlation to that. Also, a lot of the knock against it is that gold doesn't have a cash flow attached to it. But the gold bugs would argue that because we're now in a world where we have ultra low interest rates or negative interest rates, the cost of owning gold isn't as high as it used to be because there's no cash flow attached now to a lot of the bonds that are out there right now from a governmental standpoint. And then, of course, some people like the fact that it can't be created or destroyed. There's only a certain amount of gold buried in the earth, so it's immutable to some degree. But also the flip side of that is that in a real crisis, you're not going to be shaving off parts of your gold bar to go buy milk. So the utility of gold is, I think, brought into question on that side. The con, as I just mentioned, would be the utility, because if we're in a Armageddon zombie type situation, these are some of the arguments that Warren Buffett likes to make, that you can't really use gold to purchase anything because no one really would accept it as a medium of exchange in such small amounts. There's no cash flow attached to it, which makes it very difficult to value. So modern valuation methods tend to rely on cash flows to value not only companies, but bonds, real estate. And because it doesn't have a cash flow, it makes it very difficult to evaluate. The inflation-adjusted return since 1980 has actually been really marginal. And this was something that I found, interesting during some of the research, was that, inflation-adjusted, if you were to go back to 1980, when the last time gold had a big spike upward, and if you apply inflation to that price and then stretch it out to today, well, gold would have to get back to something like $10,000 an ounce to get back to the inflation-adjusted price that it was in 1980. Therefore, some of the people that are against having gold in a portfolio would say that it's actually not been a very good inflation hedge because it has, in inflation-adjusted terms, you've actually lost money. And, like I said, due to it's a difficult medium of exchange. So, you can't buy milk with using gold, but also tax treatment for gold transactions can be very onerous. So, again, during the research process, this was discovered by our team that for anyone selling gold that they have a gain in, the gold, whether it's gold coins or an ETF like the GLD, would be taxed at the collectibles rate. So it's a unique asset in that way, because collectibles tax rates are much higher than individual tax rates. Certainly, long-term capital gains rates of 22%. Collectible tax rates, I believe, are in the mid-30s. So it's a pretty tax inefficient asset if you're going to be selling it at any point. I just wanted to wrap up the call today. Similar to what we were talking about last week, was that some of the things that we're doing as an investment team, we're continuing to have discussions with some of the managers we're using. We're continuing to look at opportunities on the equity side and bond side for companies that can thrive through the current environment. I think that's what's driving a lot of the turnover that you're seeing in the accounts right now, which is good because a lot of those companies are showing they can prosper right now. And we're stress testing a lot of the business cases using some pretty draconian metrics. And then on the advisory team, I know we've got some plans to potentially bring out some publications, but we're looking at, again, peeling through the CARES Act, the stimulus act that just came out, I think it was last week, seeing what provisions there might be in there from a planning and opportunity standpoint. And I think most importantly, as you're probably continuing to see, we're staying in continuous contact with clients. And I think that's really important during stressful periods of time like this, because it does tell you that, we certainly care about what happens to everybody and their financial situations through this whole ordeal. And that, again, through some of my interactions with my peer group, and most other advisors aren't as proactive as we are right now, and they're not being. So if you do know anyone that we could help along those lines, we would certainly be happy to take care of the people that are important to you. So with that, I do want to thank you for taking the time to tune in today. It's been a pleasure. Please continue to send some of your topic ideas into the questions at gratuscapital.com. And I look forward to speaking to you at some point in the future. Thank you.